So hello again and welcome to this special webinar brought to you by our friends at EOS Property Group. My name is John Koch. I'm from Your Investment Property Magazine, and I want to give you a special welcome and thanks to the folks at EOS Property Group for putting on this webinar today. Today's presentation is going to take an in-depth look at their armchair developer program, and it aims to help regular property investors access developers' profits. So we're just about to get started, but before we do, I just want to go over a few bits of housekeeping. So there's no need to take too many notes now because we'll be providing you with a link within the day to the recording of this session. Also, please do interact with our presenters. You're welcome to pose any questions you may come up with using the questions pane there on the right-hand side of your screen. And please don't be discouraged if they don't answer your question, they don't get your questions right away. We'll be holding them until the end of the webinar, where we'll set aside some time to get into all of your pressing questions. So as I said, today's webinar is, of course, brought to you by EOS Property Group. EOS is a small WA-based investment group that specializes in providing high-quality property investments, focusing on strong profits and good cash flow. They believe there are more efficient and sophisticated ways to build a property portfolio than just buy and hold. Consequently, EOS has developed a concept called the armchair developer, whereby everyday investors can benefit from the advantages normally reserved for developers. EOS oversees the entire project, and the investors take ownership of a brand new, well-located investment property significantly below market value. EOS began operation in 2010 and currently have around $35 million worth of projects under construction. The properties are located in both the northwest of WA and more recently in the Perth inner suburbs. Tonight, we have two of the founding directors of EOS Property Group, Derek Jones and Chris Granary. Both Derek and Chris come from an education background and have been involved with property investment for over 25 years. Their expertise is not only in building personal portfolios of residential property across Australia, but they both have had many years' experience in developments in commercial property. Tonight, they hope to talk a little about EOS and explain a bit more about how their armchair developer concept can benefit investors. So, Chris and Derek, you guys take us through it. Welcome to
Right,
the.
thanks, John.
Thanks, John.
Right, folks, my name's Derek Jones, and I'll take the first part of this presentation for you, and then Chris will come up with the second part. So without any further ado, I think John's given you a fairly good rundown of EOS Property Group and what we do, and we'll just now take you through the armchair developer process in a little bit more detail. So, as John did say, it's very much, in our opinion, a new investment concept, and it's a concept that provides a large number of benefits to our clients. So, I guess if we go back to part of John's introduction there, he talked about EOS starting about almost 3 years ago now, and part of the genesis, if you like, behind the whole thing was that we had a good look at the property investment process and how it works for most people. And we decided that there's got to be something better. And when we started EOS Property Group, most of you would be aware that at that point in time, property was relatively stagnant, and we wanted to see if we could do something a little bit different. And we turned that whole process, if you like, upside down and identified that the developers are the ones that get that kickstart profit. And we figured out, well, if we could get that profit into our investors' hands or their pockets or their bank account, whichever way you want to look at it, then that is to their advantage. So we came up with this notion of the armchair developer concept, and we recognised that it had certainly a lot more potential for profit, certainly well and truly above the normal market purchases that many investors make. And because there was inbuilt profit, then there was less reliance on capital growth, because whilst capital growth is important, and we're not denying that at all, getting that kickstart at the beginning is certainly to our advantage if we are aiming to build ourselves a property portfolio. And I guess the other one too was very much because our clients are getting property at below market rates, it means that their rent returns as a percentage of funds invested is much, much higher than it would be if they were buying something through the open market. So the armchair developer process is certainly something more than just pure growth, because it also considers cash flow. It's certainly more than just a renovation strategy. There's no renovation process involved. It is a development strategy. It's not a pure cash flow strategy. In other words, we're not looking at mining towns and the risks associated with those. And it's certainly much, much more than a simple buy and hold strategy where you wait for the market to take its turn and to move forward. So they're the sort of the underlying principles behind the whole process. So when we put a project to our clients, it's got to meet some, I guess, some number criteria, if you like. And the first thing that we've got to aim for a minimum of 20% profit on funds invested. Now, I guess you could argue the toss about whether the next example is a 20% or a 25% profit, but bottom line is our clients would be looking at a property worth $400,000 and only having invested $320,000. So their profit in terms of equity would be in the vicinity of $80,000 in that particular example. So they're the sorts of things that we're looking at, and they're the sorts of numbers that we would like to return to our clients. And what we've got on the screen now is just some numbers for you to look at, and these are the estimated profits on some of our current projects that are currently in process, if you like. And you'll see that the first four are in the vicinity of $100,000, or give or take a little bit. The fifth project there, the Renew Street project, is whilst it's only got an expected profit margin of say $66,000, the entry level investment and the overall level investment on that particular project is much, much less than the first four projects. So the percentages are there, the percentages returns are there, the rent returns are exactly the same. It's just that in the Renew Street example, the total funds invested are considerably less than the other four projects shown on your screen. So just to capture that, what I've just said for you, it's very much about building equity without having to wait for years of capital growth. It's about owning a property with a higher rent return than market rates. It's about owning a property in a high growth area, in a well selected and chosen area. And it gives our investors the opportunity to take an initial profit if they wish by selling on completion. Now obviously there may be tax issues associated with that, and that's something you would need to talk to your accountant about. But because you're getting a higher rent return and you're getting that inbuilt equity, then it means that those of you who are looking at building a portfolio can actually accelerate that whole process because of the nature of the investment that you've just thrown into the mixer for you. I'll now pass on to Chris Granary, my co-director, and Chris will take you through how the actual process works. Chris?
Thanks, Derek. Folks, we wanted to spend a little bit of time looking at the process, and that'll perhaps help you understand how we can generate these sorts of returns that Derek was speaking about. Before we even talk to our investors, we're searching for high quality investment property that'll certainly produce that developer's profit that Derek mentioned, but it also has to be a standalone good investment. So regardless of whether it was generating developer's profit or not, it'd still be a good property in terms of a buy and hold scenario. So we search for land that'll have all those criteria that you look for those sorts of long-term investment growth, that close to CBDs, shopping opportunities, schools, recreational facilities, employment nodes, arterial links, highways, freeways, railway links, those sorts of things. So it's got to firstly address all those issues. And then secondly, of course, it has to be able to produce the sorts of profits that we anticipate for our investors. So at any one time, we may well be rejecting 4 or 5 development sites every week in our process to try and find one that actually suits our criteria. And it may take 2 or 3 months to find the most suitable site for us. But given that we've found the site, we'll then do the calculations. We know what the land potentially is going to cost us, and then we work out vaguely what the construction costs are likely to be, and we put those together to see if there's a profit margin in it for the investor. So, for example, if we know that per investor the land will cost $100,000, and we know the construction costs and the other development costs will be $220,000, there's a total cost to the investor there of $320,000. But before we begin the process, we will have got some design plans together. We'll have gone to a valuer and said, if we were to build these buildings right now and they were finished on this particular site, what would be the current market valuation? And based on their report, we can then estimate the potential profit to our investors. So in this little example, the current market value for these design projects would be $400,000. As a consequence, there's an $80,000 profit in it for our investors and a percentage return of 20%. And looking at a couple of rent reports, we'll be able to reduce rent returns in excess of 7%. So based on that criteria, we'd be happy then to take that proposal to our investors. So let's explore that a little bit further. Say, for example, we found a site and we believed that we could get 8 units on that site, 8 apartments. We would then be seeking, we'd then be seeking 8 investors. Therefore, there's one investor per unit, of course. And these, we would then form the joint venture, which deposits funds in order to purchase the land outright. So each of the investors contributes $100,000 into the joint venture account, and those funds are used to purchase the land. And so the land is held in the names of those 8 people. And the land is held, therefore, without debt, and we're able then to progress the development because there's no debt on the land. Now, at the same time, we need someone on board that will be able to conduct the entire development on behalf of the investors. And so we employ a professional development manager, and his role essentially is to do all the work. He has to go ahead and get the development approval, he has to organise the architects and consultants, the building licenses, the tenders, the contracts, the finance, oversee all the construction processes and all the other processes involved, and finally organise the strata and the occupancy certificates to hand over a completely finished product to the investor. So, and that's that armchair investor concept, so that whilst you are fully in charge, the joint venture has actually employed a development manager to do all the work on your behalf. You don't need to be an expert, you're employing one to do the job on your behalf. So off he goes and he starts the process off. And he needs to go and organise the construction phase of the project. So the joint venture has provided sufficient funds to buy the land outright, and so now the construction phase begins. And we don't require any funds from the joint venture, from the individuals at this stage. So if we know, for example, that the construction is going to cost $1.76 million, then that's $220,000 per unit for each of the investors. So we'll borrow those funds and we will go ahead and complete the construction. So the buildings are built, the project's completed, and no funds are being put in by the individual investors themselves. But now the job's done and you want to take ownership of your own particular unit. So we've got a block of land and we've got 8 units on it, and so each of the investors now wishes to take their ownership and take individual ownership of their own property, and so they borrow their proportion of the construction finance against their new unit and to put those funds back into the joint venture to repay their proportion. And as they do so, of course, they take ownership of their own unit. And once that's done, there is no need for a joint venture. That can then dissolve, and everyone now has ownership of their own unit. They can then sell it, keep it, rent it, live in it, do what they wish. They own the unit outright. And so, in summary, the investors will have paid a total of $320,000, $100,000 for the land, and $220,000 at the very end to pay back their share of the construction finance. we knew before we began that the value of this property was $400,000. That's not even taking into account any potential capital growth during the construction phase. And so they've walked away with a potential profit of $80,000. So it's that concept, that idea, that we're able to cut out the developer and allow the investor to make that developer's profit because they merely employ a development manager to do all the work on their behalf, that makes this concept work. And that's the basic outline that we apply for all of the projects. So that's the theory, that's the concept. Let's have a little look how that actually turns up in a real life example. And I'll hand back to Derek for that one to have a look at our latest development site in Beckingham.
Thanks, Chris. Obviously, with these sorts of things, it's great to actually see some numbers in real life. So that's what we're going to do now. Beckenham, for those of you who don't know, is probably about 15 kilometres sort of southeast of the Perth Central Business District. So it's relatively close. Here's the set of numbers that we're looking at, and this is a very, very good example of what we've got. In this particular case, the initial deposit is around $80,000. Now, we've done a bit of rounding here just to make the numbers roll, or allow the numbers to roll off our tongue a little bit smoother. So it's an $80,000 deposit. That money will need to be secured against your home, other properties, etc. It cannot be secured by the block of land because we need that unencumbered, as Chris explained. Then there's a construction loan, which actually ends up being the takeout loan at the end of $227,000, meaning that the total investment is $307,000. We've already got current market valuations on these off the plan at $370,000. So the investor's anticipated or estimated profit at project conclusion is in the vicinity of $63,000. Now, if I go back to the beginning of the slideshow, you may remember that there were some profit margins up there estimated in the vicinity of $100,000. This is one of those other lower total investments required projects. So you can see that the profit, whilst it's not in the $100,000 mark, it's still in the $60,000 mark, and those percentages that we talked about still remain. The particular property in itself is very close to all of those core services that you look as an investor. You know, it's the railway, it's the bus services, the freeways, the highways, so all of those major transport thoroughfares that are huge drivers in terms of capital growth. It's got good schools, got good shopping, its proximity to the CBD, or in Perth's case, like many other capital cities, there are nodes popping up away from the Perth Central Business District. So Beckenham does have access to those. And probably more importantly than anything, it's also very, very close to some of the employment nodes that exist around Vic Park and some of those light industrial areas, the Perth Airport, Midland, and those sort of places. So it does tick a lot of those boxes that you would be looking at from an investment point of view. So they're the numbers, and as we say, they are fairly attractive, but they become even more attractive when you compare buying an armchair or investing as an armchair developer with buying the same property through a local real estate agent. So we're just going to put up some more numbers for you to look at here, and just wait for those to come up on your screen, and you should be seeing them right now. In each case, we've had a valuer establish the final market valuation at about $370. Give or take a little bit, but that's good enough for today. Now, in terms of the armchair developer process, there are no purchasing costs, there are no stamp duty costs, there are no legal fees, there are no valuation. Well, there may be some valuation fees on your final takeout loan, but those big costs that you normally associate with purchasing an investment property were included in that total investment right at the beginning, that $307,000. So that's your total investment, that's your total borrowings, if we assume you've borrowed the lot, on an armchair developer process. Slip over to the local real estate agent, buy exactly the same property through a local real estate agent. You're still paying $370. Now you can negotiate prices and all those sort of things, but let's call it $370 for the sake of comparison. Your purchasing costs, and we've just allowed 5% here, which would cover your stamp duty, bank fees, solicitors fees, share of rates, those sorts of things that are normally associated with a property purchase. Sometimes they might be slightly less, sometimes they might be slightly more. But in this particular case, we've allowed $19,500 as your purchasing costs. And once again, assuming that we've borrowed the lot, our total borrowings or our total funds invested are just under $390,000. So you can see there's a significant difference in your overall borrowings. But it's more than just overall borrowings. There are also some advantages in cash flow and also equity position too. Exactly the same property as an armchair developer process has got instant equity, if you can use that word instant in a development process, has got equity in the vicinity of $63,000. Compare that to the standard purchase through a real estate agent and you're minus roughly $20,000. Your total loan is $307,000 versus $389,000. So there's a saving there of some $82,500. So your overall risk exposure is also significantly reduced. But for those of you out there who are very cash flow conscious, and that's certainly always something that we should consider, because you've got a reduced level of borrowings, and let's assume that your interest rate is 6.5%, your total interest saved in the course of a year is $5,300 odd. Now, some of you might be thinking, there's, gee, 6.5%, I can get my money at 5.2, 5.1, 5, something like that at the moment. We've taken a more conservative look at this because even 6.5% might be a little bit on the low side. But if we consider that your loan is at 6.5%, it's still a significant cash flow saving to you. We're talking in the vicinity of $100 a week in your back pocket versus the bank's back pocket. So you can appreciate what an extra $100 a week would do to you and your situation. Some questions and answers. I'll hand back to Chris and he'll take you through these bits.
Thanks, Derek. So often there's the sort of questions we get from people, and I thought I'd leap in early and maybe tackle these questions and save you the trouble of typing them up. Often we're asked, what about other costs? You talk about $100,000, for example, for the land and $220,000 for construction, but is there any other costs involved? What about stamp duties? What about developers' commissions? No. All the costings we put forward include everything. So it's all the other associated development costs, application fees, rates, interest on loan, etc., are all included in those numbers. So when we put these numbers together in our information memorandum, we're not expecting our investors to go and find more money at a later date. That's not what we plan at all. How long does it take? That's always a difficult one, folks. We're estimating about 22 months now. In previous projects, we've been a little bit short on that, and we've had a couple of delays hither and thither, and so we're now saying 22 months. Now, there's a fairly high chance it'll come in earlier than that, but we'd rather it come in early and be pleasantly surprised than to forecast an early finish date and then disappoint people by adding a month or so onto it. So we're allowing about 22 months for construction, for total development, and that's a 14-month construction period, and that's a fixed price, fixed timeline construction. When do I have to contribute the construction finance? Only at the very end. So there's the initial deposit to purchase the land, and that's it until the projects are complete. And then if you wish to do so, you can borrow the construction finance actually against the project. Or, as some people do, you can borrow the construction finance and borrow a little extra to cover that initial deposit that you put in and return that initial deposit back to where you got it from. How does EOS make its money? How do we make our money? You as a joint venture partner, the joint venture itself actually pays commission, pays the development manager to do his job, and we charge the development manager some of his commission for the work that EOS does. So for the marketing and the ongoing liaison and coordination, we charge the development manager part of his fee. And if this is so good, if this works so well, why doesn't EOS, or why doesn't the individuals in EOS invest in these developments themselves? And the answer is we do. I've certainly got an investment property. I've got some friends of mine that are involved in armchairs with us. the directors have got either themselves or their sons or daughters or sister-in-laws in these. EOS itself, the group, is actually investing in 1, 2, 3 or so of these, either as a full investment or in partnership with some of their individual investors. So certainly we are involving ourselves in these investments as well as marketing and liaising with everyone. Folks, in summary, I think these are the things that really make the armchair developer concept stand out. It does provide an opportunity for people to take a quick profit. You don't need to buy a property and wait for 3 or 4 or 5 years before it starts to generate equity. You don't need to hold on for that time period to make up that profit above the stamp duty you've paid and above the other bits and pieces that you've paid. So you can take a quick profit if you wish to do so. Yes, there's some tax implications you need to talk with your accountant about, but the opportunity is there. And that means it does give you a head start in terms of property growth. You're already that 20% ahead in the process. And because, as Derek explained, you've paid a lower than market value, you're still receiving market rent. So proportionally, your rents are that much higher. So you may be cash flow neutral or even cash flow positive, and yet you're still buying a property in a long-term growth area. So it's that combination of best of both worlds. You don't need to compromise either cash flow or capital growth. You can have both. And because it actually generates equity, it actually enhances potentially your ongoing investment potential. You're able to borrow funds. You're not held back for 3 or 4 or 5 years while your equity grows. Because you've got that built-in equity, you can actually push forward in a long-term investment strategy. And it provides a range of options for you. Sell the thing. As soon as it's finished, take the money and go on holidays. Sell the thing. Take the money, go and put it back into your home loan. Pay down some of your current investments. You can actually convert this to a profit within that development time period. But it does also provide you, if you wish to do so, with a long-term investment property in a good location and at very little holding cost, if not none at all. So, folks, I hope that's given an overall picture of what we do and how we do it. And you're most welcome to contact us at any stage and give us a ring and have a yarn about the process. If there's some things that intrigue you about this, certainly give us a ring and flick us an email, and we can provide a lot more specific detail to answer your questions in detail, as it were. We will certainly contact you over the next week or so and have a yarn. So if you've got any complex questions or intricacies you want to outline, get in contact with us or we'll contact you. And there's those details there. Now, we have got a couple of questions here that John's managed to send through to us. And to some degree, hopefully, we've been able to answer some of these. One question from Peter is, how much does the development manager cost per unit? Gee, Peter, that's a very good question. The development manager and his commissions vary. It's somewhere around 5 to 7% of the overall project he charges. So divide that by 8 or 10 or work it out as a percentage of the overall value of your project, and that will give you an underlying value. So yeah, somewhere around 7% plus GST, I think, is the figure, but that does vary depending on the project. Another question, how much is the cost of the planner? Well, the planning itself, the planning is a complex process. It involves not only sort of architects and application fees. There's a whole range of consultants that are involved in the process, and the planning departments of the local shire council. All those costs are included in the figures that we provide. So the initial deposit and the construction finance cover all the costings. Can we use the initial, here's a question, can we use the initial value as valuation when going to the bank for a loan? The answer is typically no. The banks want to do their own valuation. They never trust someone else's valuer. So at the end of the project, typically your lender will want to send his valuer through to value the project that you're going to purchase. And at the very beginning of the process, of course, we need to buy this land outright, so it needs to be unencumbered, no debt against it. And so the initial funds that people provide, the $100,000 or $80,000 or $60,000, that needs to be provided from sources outside the development. So you may have a line of credit, you may have cash, you may have equity in your own home or other properties that you can use to generate the funds for the initial deposit. Certainly at the end, you can borrow the funds against the property, but at the beginning you can't do so. What is the normal duration of these projects? Yes, Tony, it's typically, we're estimating 22 months. It may be less than that, but it may be slightly more. There's a few things that are outside our control, and all we can do is work on averages. Development approval can take 3 months. We allow 3 months. Our record is 7 weeks and 3 days, but it can take longer depending on the intricacies of the local council. And at the other end, issuing certificates of occupancy and strata titles is outside our control as well, and that can extend a little bit. So sometimes less, sometimes more. For example, the builders claim they'll build the projects within 12 months, not 14, but they're just not comfortable to sign a fixed term contract with only 12 months time. So they make it 14 and they'll sign those contracts, albeit they may be able to build in 12. So 22 months is the figures we're sort of looking at. Tony asks, are there any sunset clauses included in the contract? Not from our point of view. There is certainly the contract with the builders is a fixed time, and he pays liquidated damages if he goes over time. There is, of course, in all building contracts, some room for variations, inclement weather, those sort of things that are outside the builder's control. But if he goes a day over, he starts paying us liquidated damages. Carl asks a very good question. Is the market valuation by the valuer a current market value or projected for the time of completion? So what Carl's saying is, are we looking ahead 2 years, anticipating capital growth, and then giving an evaluation based on what it's likely to be worth in 2 years' time? No, it's the valuation right now. If that project was completed right now, to that design, on that block, what would it be worth? And that's the valuation we use. So, look, it's hard to tell, but I certainly know in the Perth projects, for example, the land value has gone up by somewhere around $400,000 or $500,000, maybe more. Well, that's just icing on the cake for the investors. We did our calculations on the valuation at the day and not on any projected values. Tony asks, this is Tony Vincenten, isn't it? Hello, Tony. How you going, mate? You've got way too much spare time because you're asking me lots of questions. Tony asks, how many projects are currently underway? 11, I believe. We've got 3 coming to completion in about 3 weeks' time, another 2 in early February, and then we've got a range of projects throughout Perth that are in different stages of development. One's just about to go into construction next week, and another one's just barely beginning. So 11 in total. Are there any currently available for investment? Yes, there is, guys. Those Beckenham ones that Derek spoke about, almost all of those have been taken up, but a couple have come back onto our stock list because the investors involved were unable to get that initial finance. They were expecting funds to come in from overseas or from mother-in-laws, and they haven't eventuated, so that has come back on the market. So there is one 2-bedder still available, that is the Rupa actually, and 2 1-bedders available, and they are actually cheaper than the numbers that Derek outlined on the webinar earlier on. Now look, guys, if you are interested, jump on the website and have a look at the property. We've just got a brand new website, so if it's a bit clunky, our apologies. It's still sort of in beta mode, but jump on the website, have a look at the projects, and flick us an email, and we can provide you with a whole range of the details that you may be looking at. So fill in a registration of interest and get back to us, and we can provide whatever requirements that you have. Folks, that appears to be all the questions at this stage, and typically what happens with these things is as soon as we close it down, you think of a really interesting question that would be really great to get an answer to, and you didn't have the time to ask it, or you forgot to ask it. So get back to us, ring us or email us, ask those questions, even those curly, embarrassing ones. You know, double check everything for us, and we will do our very best to get the answers back to you. But as I said, we will make a copy of this webinar available to you, and we'll also contact you with an email or a phone call over the next week or two, so you'll be able to ask all those difficult and awkward questions of us during that time. Here's one from Carl. Does GST apply on later sale of the property? Carl, that is a very interesting question. You need to really go and talk to your accountant about that. We certainly can't give you tax advice. There is the potential that GST is payable on the property if you sell it within the first 5 years, provided you are seen by the ATO as a developer. This is if you're seen as an investor, a long-term investor, then you may not be exposed to GST. And it's that sort of intention stuff that you need to consider and talk to your accountant about, because we certainly can't give any tax advice.
So it looks like
guys, we might wrap the webinar. Oh, there is John's back to wrap it up by the sound of things.
Hello. So it looks like it is time indeed to wrap things up. You can always pose your questions to me, and I can pass that on, or just go ahead and go to EOS's website. All that information is there for you, and get a hold of Derek and Chris if you have any further questions. And again, we want to thank you so much for joining us for today's webinar. And please do feel free to reach out to the folks at EOS if you have any further questions, or if you'd like any further information about their armchair developer program. So again, thank you very much, and we will catch you again soon. So Chris, Derek, thank you so much for all the information that you shared today.
Thanks, John.
Thanks, John. Thanks, everyone. Have a great evening.
Thank you.